Long before coins or paper bills existed, humans relied on the barter system to trade goods and services. Barter was simple. One person exchanged something they had for something they needed. For example, a farmer might trade grain for a pot made by a craftsman. While effective in small communities, barter had major limitations. It required a double coincidence of wants. Both parties needed to want exactly what the other had. It was difficult to measure the relative value of different goods, making large or complex transactions challenging. Perishable goods, like food, could not serve as stable stores of value. These limitations created the need for a more universal medium of exchange, something widely accepted that could represent value, store wealth, and facilitate trade across larger distances. Long before coins or paper bills existed, humans relied on the barter system to trade goods and services. Barter was simple. One person exchanged something they had for something they needed. For example, a farmer might trade grain for a pot made by a craftsman. While effective in small communities, barter had major limitations. It required a double coincidence of wants. Both parties needed to want exactly what the other had. It was difficult to measure the relative value of different goods, making large or complex transactions challenging. Perishable goods, like food, could not serve as stable stores of value. These limitations created the need for a more universal medium of exchange, something widely accepted that could represent value, store wealth, and facilitate trade across larger distances. Part 1. The origins of money, from barter to the first coins. The first forms of money was not coins at all. Early societies experimented with items that had intrinsic or widely recognized value. Shells. In many cultures, shells were used as currency because they were rare, durable, and portable. Livestock. Animals like cows or sheep represented wealth and could be traded for goods or services. Grain and other commodities, staples such as barley or rice, served as both food and currency, storing value for communities. Over time, as trade expanded, societies recognized the need for standardized units of exchange. This led to the creation of the first metal coins. The first coins, around 600 BCE in Lydia, modern-day Turkey, were minted using a naturally occurring metal called electrum, a mixture of gold and silver. These coins had several advantages: standardized weight and purity, allowing people to trust their value; durability, coins could last for years without deteriorating; portability, easier to carry than livestock or heavy commodities. Other ancient civilizations, including China, Greece, and India, soon developed their own forms of coinage, often stamped with symbols of authority or religious imagery. Coins became more than just a medium of exchange. They were also a symbol of power and trust. How early money shaped societies? The introduction of coins and standardized currency transformed societies in multiple ways. Trade expansion. People could trade over longer distances, creating regional and international trade networks. Economic specialization. With a reliable medium of exchange, individuals could focus on specific crafts or professions, knowing they could trade for other necessities. Central authority. Rulers and governments began controlling the production of coins, centralizing economic power, and strengthening their influence over populations. Cultural significance. Coins often carried images of rulers, gods, or cultural symbols, reinforcing identity and legitimacy within a society. In essence, the creation of coins was more than just a financial innovation. It was a turning point that allowed humans to build complex economies, formalize governments, and shape civilization itself. The transition from commodity to trust. Even though coins had intrinsic value due to their metal content, People soon realized that trust in the issuing authority mattered more than the metal itself. This idea laid the foundation for future developments. Governments could issue paper money backed by authority rather than physical commodities. Trust became the core of financial systems, a principle that underlies modern banking and digital currencies. The evolution from barter to coins illustrates that money is ultimately a social contract, a shared belief in value that enables exchange. By understanding these origins, we begin to see how money is not just about economics. It shapes societies, politics, and human behavior. Part 2. Ancient Civilizations and the Standardization of Value. After the first coins emerged in Lydia, ancient civilizations quickly realized that standardized money could transform economies. Coins were no longer just convenient tools. They became symbols of trust, authority, and cultural identity. Mesopotamia and the birth of written records. In Mesopotamia, around 3000 BCE, societies used grain, silver, and other commodities as proto-money. But beyond physical exchange, they developed written records to track debt and trade. Clay tablets documented loans, trades, and payments, creating a system of accountability. This innovation allowed long-distance trade and more complex economic arrangements. The combination of standardized goods and record-keeping laid the foundation for formal banking and taxation systems. This shows that money's power comes not only from its physical form, but also from systems of trust and administration. China and the first paper money. China was a pioneer in taking money beyond coins. By the Tang Dynasty, 7th to 10th century CE, merchants used promissory notes instead of carrying heavy coins for large transactions. During the Song Dynasty, 11th century CE, the government issued official paper money backed by the state rather than metal. Paper money expanded trade across vast regions, simplified taxation, and reduced the risks associated with transporting metal coins. China's innovation illustrates that money evolves within economic complexity and the needs of societies to facilitate exchange efficiently. Greece and Rome, coins as power and propaganda. In ancient Greece and Rome, coins were more than currency. They were tools of influence. Coins displayed images of rulers, gods, or military victories, reinforcing political legitimacy. Standardized coinage allowed for stable taxation, salaries for armies, and public infrastructure, enabling the growth of cities and empires. The widespread acceptance of coins helped integrate distant regions into a single economic system, strengthening state control. Coins were now intertwined with culture, politics, and identity, not just trade. The role of trust in ancient economies. Across civilizations, one consistent pattern emerges. Money requires trust. People needed confidence that a coin, grain, or note would be accepted in return for goods or services. Governments and authorities became guarantors of value, creating early forms of centralized financial systems. This trust allowed economies to expand beyond local markets, enabling specialization, urbanization, and social stratification. Money is as much about belief and authority as it is about metal or paper. From standardized value to global trade. By the late antiquity period, standardized currency enabled international trade. Merchants could trade across regions with coins recognized by multiple cultures. Banking practices, such as loans and currency exchange, emerged to facilitate cross-border commerce. Ancient trade networks laid the groundwork for the modern global economy, showing that early standardization was a precursor to today's interconnected financial systems. The lesson is clear. Without standardized money and trust in its value, civilization could not sustain complex economies or long-distance trade. The big picture. Ancient civilizations demonstrate that money is not just a medium of exchange. It is a foundation for society, governance, and culture. Standardized coins and records enabled growth, specialization, and empire building. Trust in authority and the consistency of value were essential for economic stability. The innovations of Mesopotamia, China, Greece, and Rome show that money evolves with societal complexity, trade demands, and governance needs. By understanding how ancient civilizations standardized value, we can see the deep historical roots of modern banking, digital currencies, and global finance. Part 3. The Rise of Banks and Credit in Medieval and Renaissance Europe. After ancient civilizations laid the foundation of standardized currency, Europe entered a period where trade expanded and economies became increasingly complex. This evolution created the need for intermediaries who could manage money, credit, and risk, the birth of banking as we know it today. Early European trade and the limits of coins. During the Middle Ages, trade expanded beyond local markets. Merchants traveled across regions, from Italy to the Low Countries, carrying coins of different origins. Coins were heavy, scarce, and inconsistent in value, making large transactions risky and cumbersome. Barter and local currencies could not sustain emerging international trade networks, prompting innovative solutions. The need for a trusted financial intermediary became clear. The birth of banking in Italy. Italy, with its thriving city-states like Florence, Venice, and Genoa, became the cradle of modern banking. Florentine banks, such as the Medici Bank, founded in the 14th century, began offering services like currency exchange, deposits, and loans. Letters of credit and bills of exchange allowed merchants to transfer funds safely without moving large amounts of coinage. Banks not only facilitated commerce, but also financed governments, armies, and public projects, intertwining finance with political power. Banking emerged as a system based on trust, contracts, and reputation, rather than solely on tangible money. The concept of credit transformed economies. Merchants could borrow against future profits, allowing expansion of trade and production. Early banking families, like the Medicis, leveraged credit to accumulate wealth and influence, demonstrating the power of financial networks. Credit introduced the principle that money today could represent promise and trust in the future, laying the groundwork for modern finance. Credit was a leap from physical money to abstract financial instruments, enabling more dynamic economies. Medieval and Renaissance innovations. Several key innovations during this era shaped the financial world. Double-entry bookkeeping, developed in Venice and Florence, allowed accurate tracking of assets, liabilities, and profits, essential for managing large financial operations. Letters of exchange. Merchants could transfer value safely across regions without carrying coins, reducing risk of theft or loss. Banknotes and deposits. Some banks issued notes that could be redeemed for coin, an early form of paper money backed by financial trust. Investment in public projects. Banks financed infrastructure, military campaigns, and trade expeditions, illustrating the intersection of finance, politics, and societal growth. These innovations demonstrate how finance became central to both commerce and governance, shaping Europe's economic landscape. Trust, reputation, and risk management. Banks thrived on trust and reputation. Borrowers and lenders relied on the bank's integrity, reputation, and solvency. Legal frameworks and contracts were essential to enforce obligations and manage disputes. Risk management became a core skill. banks had to balance loans, deposits, and investments to survive economic fluctuations. Financial institutions became pillars of societal stability, influencing trade, politics, and culture. The big picture. The rise of banks and credit in medieval and Renaissance Europe shows that money is more than coins or paper. It is a system built on trust, innovation, and social cooperation. Banking facilitated the growth of cities, commerce, and empires. Credit expanded economic potential beyond physical wealth, creating new forms of power and influence. These developments set the stage for modern financial systems, global trade, and the emergence of central banks. Understanding this era highlights the evolutionary link between early coins and the complex, interconnected financial world we navigate today. Part 4. The Gold Standard and the Rise of Modern National Currencies. By the 17th and 18th centuries, Europe's financial systems had grown increasingly complex thanks to banks, credit, and trade expansion. With the rise of nation-states and international commerce, there emerged a need for stable, universally recognized currencies, leading to the establishment of the gold standard and modern national currencies. What is the gold standard? The gold standard is a monetary system in which a country's currency is directly linked to a specific amount of gold. Each unit of currency represents a fixed weight of gold, guaranteeing value. People could theoretically exchange currency for gold, ensuring trust in the money's worth. By tying currency to a tangible commodity, governments aimed to reduce inflation and stabilize trade. The gold standard became the backbone of international finance, facilitating cross-border trade and investment. Why nations adopted the gold standard? Several factors drove the adoption of gold-backed currencies. Stability. Gold provided a reliable measure of value, protecting economies from excessive inflation. International trade. With multiple countries trading, a universally trusted standard simplified exchange rates and pricing. Trust and credibility. Linking money to gold reassured citizens and foreign traders that currencies had real, tangible backing. National prestige. A strong gold-backed currency projected economic power and political stability. Countries like Britain, France, and later the United States became leaders in establishing gold standards, creating a global financial framework. The impact on economies. The gold standard shaped both domestic and international economies. Trade expansion. Predictable currency values enabled merchants to engage in long-distance trade without fearing devaluation. Investment confidence. Investors trusted gold-backed currencies, encouraging capital flows, industrialization, and infrastructure development. Government policy was constrained by gold reserves, which limited excessive money printing, but sometimes restricted economic flexibility. While the system provided stability, it also imposed rigid constraints during financial crises, a factor that would later lead to its eventual decline. The rise of modern national currencies. Alongside the gold standard, countries began issuing national currencies that reflected political sovereignty. Coins and banknotes were standardized, carrying national symbols, leaders' portraits, and emblems. Central banks gained authority to regulate supply, stabilize markets, and control credit. National currencies replaced a patchwork of regional coins, creating uniformity and ease of domestic commerce. This period marked the transition from commodity-based money to government-backed currency, laying the foundation for modern financial systems. The shift from gold to fiat money. Although gold provided stability, economies eventually transitioned to fiat money, currency backed by government trust rather than physical gold. Fiat currency allowed for greater flexibility in monetary policy, enabling governments to respond to recessions, wars, or economic shocks. Trust rather than metal content became the cornerstone of value, echoing principles first seen in ancient coinage and early banking. This transition paved the way for digital currencies and modern financial instruments, where faith in the system is as critical as tangible assets. The big picture. The gold standard and modern national currencies demonstrate how societies evolved from tangible to abstract representations of value. Standardization and government backing fostered trust, stability, and global commerce. Economic systems became increasingly centralized, with banks and states controlling currency supply. These developments set the stage for today's complex financial world, where money, credit, and trust intersect to drive economies and influence global power. By studying this era, we see that money is not just a medium of exchange, it is a tool of governance, trust, and global integration. Part 5. Financial Crises and the Evolution of Banking Systems. As modern national currencies and the gold standard became entrenched, economies grew more complex, trade expanded globally, and banks assumed increasingly central roles. However, with growth came vulnerability. Financial crises emerged, testing the resilience of banking systems and shaping their evolution. The nature of financial crises. Financial crises are periods when the economic system experiences sudden instability, often marked by bank failures or runs where depositors withdraw funds en masse, collapses in stock or commodity markets, credit freezes, halting lending and trade, declines in confidence in currency or financial institutions. Crises reveal the interconnectedness of banking, currency, and trust, showing how a problem in one area can cascade through the entire economy. Historical examples of crises. The Tulip Mania, 1637, Netherlands. Speculation on tulip bulbs led to astronomical prices, followed by a sudden crash, highlighted the dangers of asset bubbles and collective speculation. The South Sea Bubble, 1720, England. Investors overvalued shares of the South Sea Company, which collapsed, ruining thousands. Early example of market manipulation and speculative frenzy impacting the broader economy. The Panic of 1907, United States. Bank runs and liquidity crises threatened the entire financial system. It led to the creation of the Federal Reserve System in 1913, establishing a central bank to stabilize money and credit supply. Each crisis taught societies that trust, regulation, and oversight are essential to prevent systemic collapse. Evolution of banking systems. Financial crises prompted innovations in banking and regulation. Central banking. Institutions like the Bank of England and the Federal Reserve acted as lenders of last resort, stabilizing currency and preventing panic. Deposit insurance. Systems were created to protect depositors and maintain confidence during turbulent times. Regulatory frameworks. Governments introduced oversight to monitor risk, capital requirements, and lending practices, reducing vulnerability to shocks. Global coordination. Financial crises showed that national economies are interconnected, necessitating coordination to manage international currency flows and trade. Banks evolved from simple intermediaries into complex institutions managing currency, credit, risk, and trust. Lessons learned. Trust is fragile. Even established banks and currencies can fail if confidence erodes. Diversification is critical. Economies and individuals must spread risk across sectors, assets, and regions. Regulation matters. Oversight balances innovation and stability, protecting the broader system from collapse. Adaptation is key. Banking systems must evolve in response to crises, technological changes, and global dynamics. Financial crises are not just economic events, they are lessons in human behavior, governance, and systemic risk management. The big picture. The history of financial crises demonstrates that money and banking are more than tools of commerce. They are instruments of societal stability and power. Trust and regulation are as vital as gold, coins, or paper in maintaining economic health. Understanding crises provides insight into modern financial instruments, central banking, and global economic interdependence. By studying these turbulent periods, we see how banks, regulations, and policy frameworks evolved to support increasingly complex economies, paving the way for today's global financial systems. Part 6. The Birth of Credit Cards and the Consumer Economy. As banking systems evolved and economies stabilized, the 20th century saw the emergence of a new form of money and credit, the credit card. This innovation fundamentally transformed consumer behavior, commerce, and financial systems. The origins of the credit card. The concept of credit for consumers existed in various forms. Charge plates and store cards in the early 1900s allowed purchases at specific stores with deferred payment. Merchants extended lines of credit to trusted customers, which worked in small communities but could not scale. The modern credit card emerged in the 1950s. Diners Club, 1950, introduced the first general-purpose charge card, initially for travel and entertainment. Bank-issued credit cards followed, allowing consumers to borrow funds from banks to make purchases at multiple merchants. This innovation enabled instant access to credit, reshaping spending habits and economic dynamics. How credit cards changed consumer behavior. Credit cards introduced new patterns of consumption and financial interaction. Deferred payment. People could buy now and pay later, increasing purchasing power and stimulating demand. Convenience and security. Carrying plastic cards reduced the need for cash, providing a safer and more efficient means of payment. Consumer data and marketing. Banks tracked spending, allowing targeted marketing and the growth of consumer-focused financial products. Psychological impact. Credit made money feel more abstract, often encouraging higher spending and reshaping attitudes toward debt. These changes contributed to the rise of the consumer economy, where consumption became a central driver of growth and lifestyle. Economic implications. The credit card era transformed financial systems and macroeconomics. Expansion of credit. Widespread access to consumer credit boosted retail sales, industrial production, and economic growth. Interest and fees. Banks generated new revenue streams through interest on outstanding balances and service fees. Debt dynamics. Household debt became a significant factor in economic cycles, influencing recessions and recoveries. Financial inclusion. Credit cards allowed people without large savings to participate in broader economic activity, although it also introduced risks of over-indebtedness. The credit card exemplifies how financial innovation can reshape both individual behavior and systemic economic trends. The role of technology. Credit cards were not just financial tools, they were a technological leap. Magnetic stripes and electronic verification allowed real-time authorization, increasing security and efficiency. Automated clearinghouses and centralized banking networks enabled large-scale processing of transactions. Data analytics provided insights into consumer behavior, allowing banks to tailor products and manage risk. Technology amplified the power and reach of consumer finance, setting the stage for digital payments, online banking, and mobile wallets. The big picture. The birth of credit cards illustrates several key lessons. Money is not static. It evolves with societal needs, technology, and economic innovation. Credit transforms economies by extending purchasing power and stimulating consumption. Financial systems and consumer behavior are deeply intertwined, shaping growth, risk, and opportunity. Trust, convenience, and technology remain central pillars in modern finance. From coins in ancient Lydia to plastic cards in the 20th century, money has continually evolved, reflecting human ingenuity, societal complexity, and the constant search for efficiency and trust. Part 7. The Digital Revolution: Online Banking and Electronic Payments. The late 20th and early 21st centuries witnessed a technological transformation in finance. The rise of computers, the internet, and mobile technologies reshaped how money moves, how banks operate, and how consumers interact with financial systems. The emergence of online banking. Online banking first appeared in the 1980s and 1990s, driven by advances in computer networks. Electronic fund transfers, or EFT, allowed individuals and businesses to send money without physical cash. Banks offered account access via computers, enabling customers to check balances, pay bills, and transfer funds remotely. Early systems were limited in accessibility, but demonstrated the potential for global connectivity and efficiency. Online banking reduced dependence on physical branches, streamlined operations, and provided convenience for customers, laying the foundation for modern digital finance. Electronic payments and the rise of digital transactions. Alongside online banking, electronic payment systems began transforming commerce. Point-of-sale systems, or POS, replaced cash registers, allowing instant card payments. Electronic wallets and payment processors enabled secure, fast transactions across borders. Innovations such as PayPal, founded in 1998, created global platforms for transferring money safely online. These systems not only made transactions faster, but also expanded access to financial services, particularly in regions lacking robust physical banking infrastructure. Impact on consumer behavior. Digital finance changed how people spend, save, and manage money. Instant transactions. Payments could be completed in seconds, increasing efficiency for both businesses and consumers. Accessibility. Online banking enabled remote account management, financial planning, and investment tracking. Transparency. Digital records improved oversight, making fraud detection and budgeting easier. Shift to cashless economies. Many societies began relying heavily on cards and electronic money, reducing physical currency usage. Digital payments also paved the way for microtransactions, subscriptions, and global e-commerce, fundamentally reshaping economic behavior. Security and trust in digital finance. With digital money came new challenges. Cybersecurity threats like hacking, identity theft, and phishing became significant concerns. Banks and payment providers implemented encryption, authentication protocols, and fraud monitoring to maintain trust. The concept of money evolved further. Value now existed largely as digital records, reliant on secure systems rather than physical coins or notes. Trust, however, a core principle from ancient coins, remained essential, now encoded in technology rather than in metal. The globalization of money. Digital banking and payments facilitated borderless financial systems. International transactions became faster, cheaper, and more reliable. Businesses could engage in global trade with electronic settlements, reducing reliance on cumbersome wire transfers or physical currency. Digital finance contributed to economic integration, enabling countries to participate more actively in global markets. The digital revolution demonstrates that money is not just currency, it is information, connectivity, and trust embedded in technology. The big picture. The digital revolution shows how finance continues to adapt to human needs, technology, and societal changes. Money evolves from coins to paper, plastic, and now digital records. Convenience, trust, and speed remain central pillars. Global connectivity reshapes economies, enabling new opportunities and risks. By understanding this evolution, we see that modern finance is a dynamic system where technology, consumer behavior, and trust interact to shape both individual lives and global economies. Part 8. The Rise of Cryptocurrencies and Decentralized Finance, DeFi. The 21st century introduced a revolutionary shift in money, cryptocurrencies, and decentralized finance. These innovations rely on blockchain technology to create trustless, peer-to-peer financial systems. The birth of Bitcoin. In 2008, an anonymous entity known as Satoshi Nakamoto released the Bitcoin white paper, proposing a digital currency not controlled by any central authority. A decentralized ledger, blockchain, recording all transactions securely and transparently. A system relying on cryptographic proof rather than trust in intermediaries. Bitcoin represented a radical idea. Money could exist entirely as data, with security ensured by mathematics and consensus rather than governments. How cryptocurrencies work. Cryptocurrencies operate on principles that challenge traditional finance. Decentralization. No single entity controls the network. Participants collectively maintain the ledger. Transparency. All transactions are visible on the blockchain, fostering accountability. Scarcity. Many cryptocurrencies, like Bitcoin, have a fixed supply, protecting against inflation. Security. Cryptographic algorithms secure transactions, making fraud or counterfeiting extremely difficult. This combination allows for trustless financial interactions, reducing reliance on banks and intermediaries. The expansion into DeFi. Decentralized finance, DeFi, takes cryptocurrencies further by creating financial instruments and services without traditional banks. Lending and borrowing platforms. Users can lend crypto to earn interest or borrow against assets without intermediaries. Decentralized exchanges, or DEXs, enable peer-to-peer trading without centralized authorities. Stablecoins, cryptocurrencies pegged to fiat currencies to reduce volatility. Yield farming and staking, innovative ways to generate returns using crypto assets. DeFi represents a parallel financial ecosystem, offering opportunities and risks outside traditional regulatory frameworks. Implications for consumers and economies. Cryptocurrencies and DeFi impact society in profound ways. Financial inclusion. People without access to banks can participate in global finance using digital wallets and mobile devices. Decentralization removes the need for banks, potentially reducing fees and improving efficiency. Volatility and risk. Cryptocurrencies can swing dramatically, introducing new forms of financial uncertainty. Regulatory challenges. Governments struggle to balance innovation with consumer protection and financial stability. These innovations challenge long-standing assumptions about money, trust, and financial governance. Trust redefined. In traditional money, trust was placed in governments, banks, or regulatory systems. In cryptocurrency, trust shifts to mathematics, code, and decentralized consensus. The system operates without a central authority, yet remains functional, secure, and verifiable. This evolution highlights a key lesson. Money is ultimately a system built on collective belief, whether in institutions or algorithms. The big picture. Cryptocurrencies and DeFi illustrate that money is dynamic, evolving alongside technology and societal needs. Trust can be embedded in code, not just people or institutions. Financial systems are moving towards more decentralized, global, and digital frameworks, expanding possibilities for inclusion and innovation. Part 9. Central banks and the control of modern economies. While cryptocurrencies and digital finance offer decentralization, the modern global economy is still largely shaped by central banks. These institutions play a crucial role in stabilizing currency, regulating money supply, and influencing economic growth. The role of central banks. Central banks are government-established institutions tasked with managing a country's financial system. Their main responsibilities include issuing currency, ensuring a reliable, standardized currency for domestic use, controlling money supply, adjusting interest rates and reserves to influence inflation and economic activity. Lender of last resort, providing liquidity to banks during financial crises to prevent systemic collapse. Maintaining financial stability, supervising banking institutions and monitoring risks within the financial system. These roles make central banks cornerstones of national and global economic stability. Historical evolution. Central banks evolved over centuries to meet the demands of increasingly complex economies. The Bank of England, 1694, one of the first modern central banks, created to finance government debt and stabilize currency. The Federal Reserve System, 1913, USA, established to manage banking crises, control inflation, and provide economic stability. The European Central Bank, 1998, oversees monetary policy for the Eurozone, balancing economic growth and inflation across multiple countries. Central banks emerged as mediators between governments, markets, and the public, shaping both domestic policy and global finance. Monetary policy and economic influence. Central banks use several tools to influence economies. Interest rates, adjusting borrowing costs, affect spending, investment, and consumption. Open market operations, buying or selling government securities to control liquidity. Quantitative easing, or QE, injecting money into the economy during downturns to stimulate growth. Through these mechanisms, central banks directly affect inflation, employment, and overall economic health. Balancing power and trust. Central banks operate on trust and credibility. Public confidence ensures currency stability and prevents panic. Decisions must be transparent to maintain market stability. Mismanagement can lead to hyperinflation, recessions, or financial crises. The central bank's influence illustrates the delicate balance between authority, economic policy, and social trust. Central banks versus decentralized finance. The rise of digital currencies poses a challenge and complement to central banking. Cryptocurrencies operate independent of central control, emphasizing decentralization and peer-to-peer trust. Central banks maintain authority but face pressure to adapt policies, issue digital currencies, CBDCs, and regulate new financial instruments. The interaction between traditional banks and DeFi will shape the future of money and economic power. The big picture. Central banks demonstrate that money is more than a medium of exchange. It is also a tool of governance and policy. Economic stability depends on institutional trust, regulation, and careful management of financial systems. The balance between central authority and technological innovation will define the next chapter in the evolution of money. Understanding central banks allows us to see how modern economies are controlled, stabilized, and influenced, connecting centuries of financial evolution to the present day. Part 10. The influence of money on society and politics. Money has never been just a medium of exchange. Throughout history, it has shaped social structures, political power, and culture and norms. Understanding this influence helps explain how economies function and how societies organize themselves. Money as a tool of power. From ancient coinage to modern banking. Governments and rulers have used money to consolidate power, fund armies, and implement policies. The ability to issue currency allows control over inflation, taxation, and trade, directly impacting citizens' lives. Wealth accumulation often translates into political influence, creating cycles where money and authority reinforce each other. Money is not neutral. It is embedded in systems of governance and social hierarchy. Social stratification and economic inequality. The distribution of money has profound effects on society. Societies with unequal access to financial resources often experience class divisions and limited social mobility. Historical examples include feudal systems, colonial economies, and industrial-era labor hierarchies, where money determined opportunities, education, and power. Modern economies see similar patterns through income inequality, access to credit, and wealth concentration. Understanding money's role in social structure shows how economic systems influence human behavior, culture, and social cohesion. Money and politics. Political systems are deeply intertwined with money. Campaign financing determines whose voices are heard in democratic processes. Governments rely on taxation and currency control to fund public services, infrastructure, and defense. Financial crises can lead to political upheaval, as seen in historical events like hyperinflation in Weimar Germany or the 2008 global financial crisis. Money is both a tool and a lever. It can empower, control, and destabilize depending on how it's managed. Cultural and psychological impacts. Beyond economics and politics, money shapes human behavior. Consumption patterns influence identity, status, and lifestyle choices. The concept of value varies culturally. What is considered wealth in one society may not hold the same meaning elsewhere. Money affects decision-making, risk-taking, and social interactions, demonstrating its psychological power. Thus, money is not just a practical tool, but a profound influence on human thought and society. Globalization and money's influence. In the modern era, money operates on a global scale. International trade, foreign investment, and global finance link nations economically. Currencies like the US dollar, euro, and yen hold influence far beyond their borders, shaping geopolitical dynamics. Financial institutions and multinational corporations leverage money to influence policy, markets, and even culture worldwide. Money today is a global force, affecting politics, society, and daily life on multiple levels. The big picture. The influence of money extends far beyond transactions. It structures societies, determines power, and shapes political systems. Access, control, and distribution of money are central to human behavior, opportunity, and conflict.
Understanding money's societal and political roles provides insight into both historical and contemporary global dynamics. Money is not merely a tool, it is a force that shapes civilization itself.
Part 11. The evolution of digital money and mobile payments. The 21st century has accelerated the transformation of money. Beyond credit cards and online banking, digital money and mobile payments are redefining how people interact with currency, making financial transactions faster, more convenient, and increasingly global. From electronic banking to digital wallets. While online banking allowed users to check balances and transfer funds, digital wallets and mobile payments took convenience to a new level. Digital wallets like Apple Pay, Google Wallet, and Samsung Pay enable instant payments via smartphones, reducing the need for physical cash or cards. Users can store multiple cards, bank accounts, and even cryptocurrency in a single secure app. Integration with loyalty programs, ticketing, and public transport systems increases daily usability. Digital wallets illustrate a shift from physical and plastic money to seamless, app-based transactions, empowering consumers to manage money in real time. Mobile payments and financial inclusion. Mobile technology has expanded access to money in regions lacking traditional banking infrastructure. Services like M-Pesa in Kenya allow users to send, receive, and store money using basic mobile phones. Millions of people now participate in the economy without ever using a bank branch, promoting financial inclusion and economic empowerment. Mobile payments reduce costs, increase safety, and allow micropayments and peer-to-peer transfers. This demonstrates that technology can overcome historical barriers, creating opportunities for people previously excluded from formal financial systems. The rise of contactless payments. Contactless payments have become increasingly popular. Tapping a card or phone on a terminal allows instant, secure transactions. The COVID-19 pandemic accelerated adoption as consumers and businesses preferred touchless, hygienic payment methods. Contactless technology also supports small transactions, such as vending machines, public transport, and retail purchases, further embedding digital money in daily life. This trend shows how speed, convenience, and user experience drive financial innovation. Integration with digital currencies. Digital wallets and mobile payment platforms are increasingly integrating cryptocurrencies. Users can buy, sell, and spend digital assets directly through apps. Some platforms support stablecoins and tokenized assets, bridging the gap between traditional finance and decentralized systems. Mobile payments are thus not only transforming fiat currency use, but also creating pathways for mainstream adoption of cryptocurrencies. The convergence of digital wallets, mobile payments, and crypto represents a major evolution in money, blurring the line between physical and virtual value. Security, privacy, and trust. As money becomes digital, trust remains critical. Advanced encryption, biometrics, and two-factor authentication protect transactions. Users must navigate privacy concerns as financial data is increasingly collected and analyzed. Regulatory frameworks are evolving to balance innovation, consumer protection, and security. Trust, a consistent theme from ancient coins to digital wallets, is the foundation of any monetary system, now embedded in technology. The big picture. Digital money and mobile payments demonstrate money is not static. It adapts to technology, societal needs, and consumer habits. Convenience, accessibility, and security drive adoption and shape behavior. The boundary between physical and digital currency is fading,
creating a seamless, global financial ecosystem. From barter to blockchain, the story of money is one of continuous evolution, reflecting humanity's drive for efficiency, trust, and inclusion.
Part 12. The Future of Money. Digital Currencies, Artificial Intelligence, and Globalized Finance. As we move deeper into the 21st century, money is evolving faster than ever. Digital currencies, artificial intelligence, and globalized finance are reshaping how we think about, use, and manage money. Central bank digital currencies, CBDCs. Governments around the world are exploring central bank digital currencies, CBDCs. These are digital forms of national currency, issued and regulated by central banks. Unlike cryptocurrencies, these are centralized, maintaining government oversight while offering instant, secure digital transactions. Countries like China, Sweden, and the Bahamas have already implemented pilot programs, while others are actively researching potential benefits. CBDCs promise financial inclusion, faster payments, and enhanced monetary policy tools, bridging traditional finance with the digital age. The role of artificial intelligence in finance. AI is transforming how money is managed, both for institutions and individuals. Fraud detection analyzes transaction patterns in real time to prevent scams and unauthorized access. Investment algorithms predict market trends, optimizing portfolio management and trading strategies. Credit scoring, machine learning evaluates borrowers' risk more accurately, enabling broader access to loans and financial services. Automated financial advice. AI-driven tools help individuals budget, save, and invest efficiently. AI enhances speed, precision, and personalization in financial systems, creating smarter, safer economies. Cryptocurrencies and decentralized finance. The growth of cryptocurrencies and decentralized finance continues to challenge traditional finance. Blockchain-based systems allow peer-to-peer lending, trading, and payments without intermediaries. Smart contracts automate transactions and enforce agreements, reducing reliance on banks or legal frameworks. The rise of tokenized assets, NFTs, and decentralized platforms introduces new forms of value, ownership, and investment. These innovations may redefine trust, governance, and the concept of money itself. Globalization and financial integration. Money has become more interconnected than ever. International trade, cross-border investments, and remittances rely on digital finance and global currencies. Stablecoins and international digital payment platforms enable near-instantaneous global transactions. This integration allows emerging economies to participate more fully in global markets, but also exposes systems to international shocks and cyber risks. Global finance demonstrates that money is not just a local tool. It is a networked, worldwide system influencing politics, trade, and society. The big picture, what the future holds. The future of money is shaped by three core principles. Digital transformation. Physical money is declining, replaced by digital currencies, mobile payments, and blockchain systems. Artificial intelligence and automation. AI enhances efficiency, security, and personalization in managing wealth and economic systems. Decentralization versus centralization. The tension between decentralized crypto systems and centralized CBDCs will define trust,
control, and the flow of money. Money is evolving into a dynamic, intelligent, and globalized system, reflecting the ongoing human quest for efficiency, security, and access. From ancient barter to blockchain, the story of money is a story of innovation, trust, and societal transformation.
Part 13. Behavioral Economics: How Money Shapes Decisions and Society. Money is not just a neutral tool. It deeply influences human behavior, decisions, and social interactions. Behavioral economics explores these patterns, showing how psychology and finance intertwine. The psychology of spending. Humans rarely behave as rational economic agents. Mental accounting. People treat money differently depending on its source or intended use. For example, a bonus may be spent more freely than regular salary. Loss aversion. Losing money feels more painful than the pleasure of gaining the same amount, influencing investment, gambling, and spending habits. Anchoring. Initial price points affect perception of value even when objectively irrelevant. These tendencies demonstrate that money influences choices and perception, often in subconscious ways. Social and cultural impacts. Money shapes social structures and norms. Status and identity. Wealth and consumption patterns are closely tied to social identity, signaling status and group affiliation. Trust and cooperation. Financial systems rely on shared beliefs in value. Societies with strong trust networks often experience smoother economic interactions. The social dimension of money is as important as its economic function. Decision-making and behavioral biases. Financial decisions are influenced by biases that often override logic. Overconfidence. Investors often overestimate their knowledge, leading to risky trades or speculation. Herd behavior. People follow others' financial actions, sometimes causing bubbles or crashes. Time inconsistency. Short-term desires often conflict with long-term financial goals, such as saving for retirement. Framing effects. The way financial choices are presented can alter decisions, such as emphasizing losses avoided versus gains earned. Understanding these biases is critical for personal finance, marketing, and economic policy. Implications for society. Behavioral economics shows that money is not just a neutral tool, it shapes actions, priorities, and social outcomes. Policymakers can design incentives, nudges, and regulations to guide behavior toward beneficial outcomes. Financial education and awareness help individuals navigate biases and make more informed decisions. Societies that understand the behavioral impact of money can better design economic systems, welfare programs, and consumer protections. The big picture. Money is both a tool and a psychological force. It influences decisions, social hierarchies, and cultural norms. Behavioral biases affect spending, saving, investing, and interacting with financial systems. Awareness of these effects empowers individuals and societies to make better financial choices. From coins in ancient markets to digital wallets today, the story of money reflects not only economics, but human psychology, trust, and social complexity. Part 14. The Economics of Innovation and Wealth Creation. Money and financial systems do more than facilitate trade. They drive innovation, entrepreneurship, and wealth creation. Understanding this connection illuminates how economies grow and evolve. Innovation as an economic driver. Innovation fuels economic growth by introducing new products, services, and technologies. Entrepreneurs take risks, investing money and resources in ideas that may succeed or fail. Successful innovations generate profits, jobs, and market expansion, creating a positive feedback loop for further innovation. Historical examples include the Industrial Revolution, which leveraged new machinery and energy sources to multiply productivity. The Information Age, driven by computing, telecommunications, and digital services. Money serves as both fuel and reward, incentivizing creativity and problem-solving. Capital, risk, and reward. Financial systems allow individuals and institutions to pool resources and share risk. Investors provide capital to startups and projects expecting future returns. Risk is inherent. Many ventures fail, but successful ones can generate exponential wealth. Banks, venture capitalists, and crowdfunding platforms facilitate this allocation of resources toward innovation. Money enables societies to experiment and innovate, which is central to long-term economic growth. The role of technology. Technology amplifies the relationship between money and innovation. Automation and AI reduce costs and increase efficiency, enabling investment in new ideas. Digital platforms allow global access to capital, markets, and customers. Blockchain and decentralized finance create new ways to fund, trade, and monetize innovation. Financial systems evolve alongside technology, shaping what types of innovation thrive. Wealth creation and economic mobility. Innovation-driven economies create opportunities for wealth accumulation and social mobility. Entrepreneurs, investors, and skilled workers can increase their economic standing. Access to financial tools like loans, credit, and investment platforms determines who can participate in wealth creation. Economies that encourage entrepreneurship, education, and access to capital tend to grow faster and generate more broadly distributed prosperity. However, unequal access to capital and networks can reinforce inequality, showing the dual nature of money and innovation. Global impact. Innovation and finance are increasingly globalized. Multinational corporations leverage technology, capital, and talent worldwide. Financial instruments like venture funds, stock markets, and digital currencies connect innovators with global investors. Countries that invest in education, infrastructure, and financial systems can attract innovation and stimulate economic growth. Money facilitates the global circulation of ideas, products, and services, shaping the future of prosperity. The big picture. The economics of innovation highlights that money is not just a medium of exchange, it is a catalyst for creativity, risk-taking, and societal advancement. Financial systems channel resources toward ventures with the potential for high impact and wealth creation. Innovation drives growth, creates opportunities, and transforms societies, but requires access, trust, and capital to flourish. From ancient trade to modern startups, money empowers human ingenuity, shaping the trajectory of civilizations. Part 15. Financial Crises in Modern Times. Lessons from the 2008 Global Recession. Even in highly advanced economies, financial crises remain a powerful force, revealing vulnerabilities in money systems, banking institutions, and economic policy. The 2008 global recession is a prime example of how interconnected modern finance has become. The roots of the crisis. The 2008 financial crisis emerged from several interconnected factors. Housing bubble. In the United States, rapidly rising home prices led to risky mortgage lending, including subprime loans to borrowers with poor credit. Securitization. Banks bundled mortgages into financial products, selling them to investors globally. Excessive leverage. Financial institutions borrowed heavily to amplify returns, increasing systemic risk. Regulatory gaps. Oversight failed to detect or prevent dangerous practices. These factors created a perfect storm where declining housing prices triggered cascading failures across banks, investors, and governments. The global impact. The crisis quickly spread worldwide, demonstrating the interconnectedness of modern financial systems. Stock markets crashed, wiping out trillions in wealth. Banks failed or required government bailouts to survive. Businesses cut back investment and unemployment soared, creating a global economic downturn. Countries with strong trade and financial links felt the shock, even if their domestic markets were initially stable. The recession highlighted how local financial issues can have worldwide consequences. Government and central bank responses. Governments and central banks intervened to stabilize the global economy. Bailouts. Troubled banks and companies received government funds to prevent collapse. Monetary policy. Central banks lowered interest rates and implemented quantitative easing, QE, to increase liquidity. Regulatory reform. Policies like the Dodd-Frank Act strengthened oversight, risk management, and transparency in financial markets. These measures restored confidence and prevented an even deeper economic collapse. Lessons learned. Risk management is critical. Over-leveraging and inadequate risk assessment can destabilize entire economies. Interconnected systems amplify crises. Global finance is highly networked. Local failures can quickly spread. Trust is the core of finance. Confidence in banks, institutions, and regulators is essential for market stability. Regulation must evolve. Financial innovation requires oversight that adapts to new instruments, practices, and technologies. Economic recovery is complex. Bailouts and monetary interventions can prevent collapse, but may also introduce long-term consequences like increased debt or moral hazard. Modern implications. The 2008 global recession continues to shape financial systems today. Banks are more rigorously monitored and required to maintain higher capital reserves. New financial instruments are scrutinized for risk and transparency. Consumers, investors, and governments recognize the importance of diversification, prudence, and long-term planning. It also set the stage for emerging technologies like digital currencies and fintech to offer alternative financial pathways. The big picture. Modern financial crises underscore that money systems, even in technologically advanced economies, are vulnerable to human behavior, systemic risk, and global interconnections. Trust, transparency, and regulation remain essential to maintaining stability in complex financial networks. Understanding crises helps societies design more resilient, adaptable, and equitable financial systems. The 2008 global recession serves as a reminder that money is not just a neutral tool. It is deeply entwined with human behavior, policy, and the stability of civilization itself. Part 16. The Rise of Alternative Investments, Stocks, Bonds, and Commodities. While money serves as a medium of exchange and store value, individuals and institutions have long sought ways to grow wealth and protect it from risk. Investments, ranging from stocks to commodities, have played a central role in shaping economies, markets, and personal fortunes.
Stocks represent partial ownership in companies, offering both potential profit and risk. The origins, the first joint stock companies, such as the Dutch East India Company, allowed investors to fund ventures in exchange for shares of profit. Modern stock markets like the New York Stock Exchange and London Stock Exchange facilitate buying and selling of shares, providing liquidity and transparency. Impact: stocks allow individuals and institutions to participate in corporate growth, fueling entrepreneurship and industrial expansion. Investing in stocks is a balance of risk, reward, and long-term strategy, shaping wealth accumulation and economic participation. Bonds are essentially loans to governments or corporations, offering fixed returns over time. Governments issue bonds to fund infrastructure, defense, or public programs, creating a stable source of capital. Corporate bonds provide companies with capital to expand operations or innovate. Bonds are often lower risk than stocks, attracting conservative investors and stabilizing financial portfolios. Bonds illustrate how money can generate predictable income, balancing high-risk investments and promoting long-term economic planning. Commodities are tangible wealth. Investing in commodities involves physical goods like gold, oil, or agricultural products. Commodities have historically served as a store of value, especially during inflation or economic uncertainty. Markets for commodities facilitate global trade and price discovery, influencing economies worldwide. Investors use commodities for diversification, hedging, and speculation, connecting financial decisions to real-world resources. Commodities link finance directly to material goods, highlighting the tangible roots of wealth and economic stability. The role of alternative investments in society. Alternative investments do more than grow wealth. They shape economic behavior and innovation. They channel resources to industries, companies, and infrastructure projects, promoting growth and employment. Investors' demand influences market trends, innovation priorities, and commodity production. Financial markets for stocks, bonds, and commodities integrate global economies, allowing capital to flow across borders efficiently. Investing is not just personal, it has societal and economic consequences, connecting individuals' financial decisions to broader economic development. Modern trends in investing. Today, alternative investments are evolving with technology and globalization. Index funds and ETFs democratize access to stock and bond markets. Algorithmic and AI-driven trading allows faster, data-driven investment decisions. Commodities and derivatives trading have become more sophisticated, enabling hedging against global risks. Cryptocurrency and tokenized assets introduce new classes of alternative investments, blending traditional concepts with digital innovation. Investments now reflect both long-standing financial principles and emerging technologies, expanding opportunities and risks. The big picture. Alternative investments demonstrate that money can generate wealth beyond simple transactions, influencing individual fortunes and national economies. Stocks, bonds, and commodities provide mechanisms for risk management, growth, and economic development. Financial markets are intertwined with innovation, global trade, and societal progress. From early joint stock ventures to modern diversified portfolios, investments shape the flow of money, opportunity, and power, reflecting human ingenuity and economic complexity.
Part 17. The Impact of Globalization on Money and Trade. In the modern era, money and trade are no longer confined to local or national boundaries. Globalization has transformed how economies interact, how currency flows, and how wealth is created and distributed worldwide. Global trade networks. Trade has always connected regions, but globalization has accelerated and expanded these connections. Historical trade routes, from the Silk Road to maritime routes, societies exchanged goods, ideas, and currency. Modern global trade.
Free trade agreements, multinational corporations, and international logistics allow products to move efficiently across continents. Economic integration. Now countries rely on imports and exports for essential goods, energy, and technology. Global trade demonstrates that money is both a tool and a language of connection, facilitating commerce on a massive scale. Currency exchange and foreign trade. Globalization introduced the necessity of currency exchange and international financial systems. Exchange rates determine the value of money across borders, impacting imports, exports, and investments. Major reserve currencies like the US dollar, euro, and yen influence global economic stability. Financial institutions and central banks monitor currency flows, stabilizing trade and protecting economies from volatility. Money is not just local, it is an interconnected web influencing global prosperity. The role of multinational corporations. Globalization has empowered corporations to operate on a worldwide scale. They manage finances, production, and logistics across countries, creating complex global supply chains. Multinationals influence employment, investment, and innovation, shaping both local and international economies. Capital flows from investors worldwide, seeking opportunities across borders, linking money to global growth and risk. These corporations show how money drives economic integration, innovation, and influence. Digital global finance. Technology has magnified globalization's impact on money. Online banking, international transfers, and digital payment platforms allow instant cross-border transactions. Cryptocurrencies and stablecoins provide alternatives to traditional currencies, enabling global peer-to-peer commerce. Financial technology reduces barriers, connecting individuals, businesses, and governments in real time. Global finance today is fast, interconnected, and increasingly digital, reflecting centuries of monetary evolution. Challenges of globalization. While globalization creates opportunities, it also introduces risks. Economic crises spread quickly, as seen in the 2008 recession. Income inequality. Globalization can exacerbate disparities between regions, industries, and social groups. Dependence on global supply chains. Disruptions from pandemics to political conflict can affect money, trade, and access to resources. Managing these risks requires cooperation, regulation, and adaptable economic strategies. The big picture. Globalization demonstrates that money is not confined to borders. It moves fluidly across countries and continents. Trade, finance, and technology are interconnected forces shaping modern economies. From ancient trading posts to digital payment networks, money has always been a bridge connecting people, nations, and economies, evolving alongside technology and society. Part 18. The Psychology of Money. How Perception Shapes Value. Money is more than numbers or currency. It is a deeply psychological concept. How humans perceive, value, and interact with money shapes behavior, markets, and even societal norms. The subjective value of money. The concept of value is not fixed. People assign different worth to money depending on context, need, and emotion. $100 may feel abundant to someone in poverty, but trivial to a millionaire. Behavioral economists call this subjective valuation, which influences decisions, risk-taking, and spending patterns. Money is therefore as much a mental construct as it is a physical or digital entity. Mental accounting. Humans categorize money in ways that influence behavior. People often separate funds into different accounts mentally, e.g., spending money, savings, windfalls.
Unexpected income, like a bonus, may be spent more freely than regular salary, despite being fungible. This mental accounting affects investment, consumption, and saving habits, shaping personal financial outcomes. Understanding these patterns helps explain why humans often make seemingly irrational financial choices. Emotional influence on money. Emotions are tightly linked to financial behavior. Fear can lead to panic selling during market downturns. Greed can drive speculative bubbles and risky investments. Joy and reward motivate spending and consumption, reinforcing economic activity. Emotional reactions often override logic, making money a source of psychological tension as well as utility. Finance is not purely rational. It is a human endeavor intertwined with perception, emotion, and expectation. Cultural and social perceptions. Money also reflects societal and cultural beliefs. Societies assign status, power, and prestige through wealth and consumption. Cultural norms shape attitudes towards saving, borrowing, and generosity. Social comparison affects how money is valued and spent, influencing markets and economic behavior. Money is a socially constructed measure of trust, effort, and identity, not just a medium of exchange. Implications for behavior and decision-making. Perception drives behavior in profound ways. Marketing and pricing strategies exploit psychological tendencies like anchoring, framing, and loss aversion. Financial planning tools leverage insights from behavioral economics to nudge people towards saving and investing. Awareness of biases allows individuals to make more rational, informed decisions about money. Understanding the psychology of money bridges personal finance, economics, and human behavior, offering insights into both individual and collective decision-making. The big picture. The psychology of money teaches us that value is subjective, emotional, and socially influenced. Money is as much a product of the human mind as it is of material or digital systems. Part 19. The Dark Side of Money. Corruption, Fraud, and Economic Crime. While money enables trade, innovation, and growth, it can also fuel corruption, fraud, and economic crime, shaping societies in dangerous and sometimes hidden ways. Understanding these dynamics is crucial for both individuals and governments. Corruption and power. Corruption occurs when individuals exploit financial systems for personal gain, often at the expense of the public. Government officials may accept bribes, embezzle funds, or manipulate contracts. Corporate leaders might engage in accounting fraud, insider trading, or market manipulation. Corruption undermines trust in institutions, destabilizes economies, and widens inequality. History shows that money is not only a tool of prosperity, but also a vehicle for abuse of power. Financial fraud. Fraud encompasses a wide range of deceptive practices, including Ponzi schemes. Investors are paid returns from new investors' funds, collapsing when inflows stop. Accounting manipulation, misstating profits or assets to mislead investors, famously seen in cases like Enron. Identity theft and cybercrime. Hackers exploit digital money systems, stealing funds or data. Financial fraud demonstrates the vulnerability of systems without transparency, regulation, and oversight. Economic crime and its impacts. Economic crimes extend beyond individuals to systemic effects on society. Money laundering hides illegal profits, allowing criminals to invest in legitimate businesses and distort markets. Tax evasion reduces government revenue, limiting public services and widening social inequality.
Corruption and crime erode confidence, discouraging investment, and slowing economic growth. These crimes show that money's potential for harm is intertwined with governance, regulation, and ethical standards. Globalization and the spread of financial crime. In a connected world, financial crime has become transnational. Offshore tax havens and complex corporate structures make it easier to hide wealth. Cybercrime and digital currencies can bypass traditional oversight. International cooperation is critical for combating fraud, corruption, and money laundering, but challenges remain due to differences in law, enforcement, and resources. Globalization amplifies both opportunities and risks associated with money. Combating the dark side of money. Efforts to reduce corruption and crime include regulatory frameworks, anti-money laundering laws, financial disclosure requirements, and corporate governance reforms. Technology, blockchain, and AI can enhance transparency, traceability, and fraud detection. Education and ethics, promoting ethical behavior and financial literacy, helps prevent abuse. While money can tempt, careful systems, accountability, and vigilance can mitigate its darker impacts. The big picture. Money is a double-edged sword. It empowers innovation, trade, and prosperity, but also facilitates corruption, fraud, and economic manipulation. Transparency, regulation, and ethical behavior are critical to ensuring money serves society positively. Understanding both the benefits and risks of money allows societies to balance opportunity with responsibility. From ancient empires to modern digital economies, money has always reflected human nature in all its complexity, creative, ambitious, and sometimes dangerously corrupt.